to the Family Enterprise USA webcast today. We're very pleased to have with us Fenimore Asset Management. The topic of today's webcast is the cost of timing the market, insights for smarter investment strategies. We're going to discover the critical factors influencing investment success in this insightful webcast. We will dive into the profound impact of market timing on portfolio performance, highlight key historical market trends, and provide actionable strategies for maximizing returns through disciplined, long-term investment approaches. Additionally, the session will examine the implications of the recent election cycle on the tax policies and the broader economic landscape, offering a comprehensive perspective on how these factors intersect with investment strategies. This webcast provides unparalleled value for investors at all levels by emphasizing the importance of understanding market behavior and avoiding the pitfalls of missed opportunities during the pivotal market moments. So we're very pleased to have Christian Snyder, who is the president of Fenimore Asset Management, as well as Will Preston, who is portfolio manager for Fenimore Asset Management. And I'll give you a little background on both of them before we get started. Christian is a CFA. He joined Fenimore in October of 2022 after working in the financial services industry for over 20 years. Prior to that, he served as Chief Operating Officer of Wealth Strategies Group at Goldman Sachs, ACO Personal Financial Management. He went to Suffolk University Law School, where he got his JD and a bachelor's degree in mathematical economics, so from Colgate. So I think he really knows what he's talking about today. So welcome, Christian.
Thank you, Pat.
Will Preston is portfolio manager, as I said, at Fenimore Asset Management. He joined the firm in 2016 as investment research analyst and was promoted to portfolio manager in May of 2020. He also is a firm principal. He served as senior investment analyst at Renaissance Capital and previously held an equity research role at C.L. King and Associates. He holds a Bachelor's of Science in Business Administration with an emphasis in finance and IT, and a minor in economics from University of Albany, and he is a CFA. So both of you, thank you so much for joining us today. I want to remind our listeners that this is being recorded, and if you have questions, please put them in the Q&A or the chat, because you cannot be heard by audio or seen by video, but we will take questions throughout. I know that some of you gave us questions when you registered, and we have those in front of us, which we're going to interject as we go along. But again, if you have a question, please put it in the Q&A or the chat, and we will attempt to monitor it as we go through. So now I'd like to turn it over to Christian.
Thank you, Pat. Appreciate the introduction. We're very happy to be here with you today, and thank you to the folks on the webcast for spending some time with us today to hear us talk about some of our favorite topics. So before I jump in, I just want to give you a sense of what we're doing. Will and I are going to talk. We both like to talk a lot, so it's going to take all our effort to keep it to 25 or 30 minutes. That's our plan. We're going to address about 2 or 3 of the questions that we received during the bulk of the presentation, and then at the end, Pat is going to ask us a handful more. And then certainly, as Pat mentioned, if there are any questions that come up during the presentation, we're more than happy to address them. I am going to attempt to both speak and move slides at the same time, which is a precarious position to be in. So bear with me if I mess anything up. So let's jump in here. Okay. So we're just going to start with a little history of the firm and kind of broad investment concepts before we get into some of the specifics that Pat mentioned. So we really like PATG and FEUSA because there are a lot of commonalities between Fenimore and the folks that these organizations serve. So we are a single family office. We are a medium-sized business. We're independently owned and operated, and we're an investment advisor to business owners primarily small, medium size, and family offices. So there's a ton of overlap between the folks on this call, Pat and her organization, and us. So our origin stories. Tom Putnam, who is the founder and executive chairman of the firm after a short stint as a college professor, came back to upstate New York, the leather stocking region of upstate New York, where Will and I actually are still sitting today, southwest of Albany, in our headquarters, to manage a pool of money that his family got when they sold their textile business in the late 60s. So he and his father started managing the family money. He was not an expert at investing. If anything, he would have described himself then as a novice. But they did what they knew best with that pool of money. They were essentially operating a de facto family office, and they were applying a business owner mindset to investing. That's something Will's going to dive into more shortly. But key takeaway, business owner mindset is kind of what we bring to the table, what Tom brought to the founding of the firm, and how we still do things today. Few highlights about Fenimore. I'm not going to go through all this, but top left of the slide, I mentioned we are 100% employee and family owned. We're fully independent. We have no outside capital in terms of the ownership of the firm. We have a little over 40 folks at the firm, a significant number of which 10, about a quarter of those are like Will. They are analysts. All they do all day, every day is look for great investments for our shareholders and clients. And then at the bottom of the slide, you'll see 100% of the Fenimore team is invested. We eat our own cooking. I would go beyond that and say a lot of us, including the folks you see in front of you today, a significant amount of our personal wealth is tied up in the firm. We really, really believe in what we do. Middle of the slide. So Tom, again, the founder, Tom Putnam, he is a man of the people. When he started the firm, he wanted someone with $100 down the street to be able to access our investment expertise, similar to a 9-figure family office. Our current shareholder and clientele base reflect that. It's about 55% of the assets we manage, which is north of $5 billion. Are in retail mutual funds. All of those funds are truly retail. They have very low minimums. We have almost 50,000 shareholders. More relevant to this group is the other side of that slide. About 45% of our assets are in bespoke SMAs, so client-specific SMA strategies. Will's going to get into some of the detail of those strategies, but those are offered primarily to high net worth families, family offices, businesses and business owners, and institutions of a lot of different variety. So you put all this together, it allows us to have a very long-term mindset. Our investment philosophy is very long-term. The way we manage the firm is also very long-term because of the ownership structure and how we operate. And we have a very unique approach to service, which we'll touch on as well. Okay. So all right. So we got a couple questions on general investment concepts. And between Will and me, we could probably spend the next month talking to you about that. You could fill up a library with books on investing. I'm going to try and do a really, really high level in like 2 minutes. It is not reflected on the slide, just to be clear. And then I'm going to hand it over to Will, and he's going to go into a lot more detail on the meat of the presentation. So if you're, a sophisticated or professional investor, you can tune out for a couple minutes and give me some latitude. We're trying to keep it really, really, really simple. So imagine you just came in to some money. You have a fundamental choice with that money. You can put it into a store of value, or you can invest it. The purpose of a store of value is to preserve the purchasing power of that money. So when I was a kid, a candy bar cost 50 cents. Now it costs, let's say, $2. So when I was a kid, if I took my 50 cents and I put it into a store of value, Ideally, that is now worth $2 today, and the candy bar I could buy when I was a kid, I can still buy today with that same money. There's a purpose of a store of value. A common example would be gold. Some people might point to Bitcoin. We would not. We're not here to talk about that today. But generally, store of value keeps up with inflation, right? Maintains your purchasing power. You can also invest your money. Investments ideally return more money to you than the rate of inflation. So the idea is the 50 cents I had when I was a kid, if I invested it, instead of buying one candy bar today, I can buy more than one, ideally several, because the rate of return on the investment has exceeded inflation, and I can buy more with my money today than I could when I was a kid. Broad brushstrokes in investing. So there's active investing and passive investing. Passive investing means you are trying to achieve the same return as something like an index. So something you might hear a lot about, you want to get the same return as the S&P 500. You can invest in that passively. So meaning all you're doing is getting the same as the index return. Active management means you generally are trying to beat a reference index or benchmark. Active managers measure themselves and are paid to exceed a benchmark. We are an active manager. Another way to say that is we have a high degree of conviction in the way we deploy our clients' and shareholders' money. Investments generally go into asset classes. The simplest way to think about asset classes are there are equities, the stock or shares of companies. There are fixed income instruments or bonds where you loan money to someone and they pay you an interest rate. There is real estate and commodities. Our world is primarily limited to equities, and most of the equities we invest in are public. So we are an active manager that invests primarily in public equities. So that's kind of the part of the investment world where we sit. And hopefully that gives folks some context. So the one important thing to hopefully keep in mind as Will goes through some more of the market update and views on the equity markets. I worked at a couple different shops. The one thing I like about the way we do things is it's actually fairly easy to understand, which should become more clear in the next few slides. It's a very accessible approach to investing, especially if you have owned or operated a business. So with that, Will, I will hand things over to you.
Oh, great. Thanks, Christian. I appreciate that. And I appreciate everyone who's sitting in on this presentation for taking the time to do so. So I'm going to start, if you want to stay back on the philosophy side for a second, Christian, I'm going to start just a few minutes just digging in a little bit more about our philosophy process and what differentiates us, as I think it'll provide valuable context that highlights, as I highlight the cost of just trying to time the market and how we think about that. So as Christian referenced, after Tom's father sold his business, he was faced with this timeless challenge of how do you grow your capital after tax while staying ahead of inflation. And history tells you over long periods of time, and in long periods of time for investing, typically think of 20 to 10, 20, 30 plus year investment horizons, that equities or stocks are by far the best asset class for doing so. And Tom and his father weren't experts in stocks or bonds or any other financial security, but as a business operator, they understood how to recognize a great business, and that's what they focused on doing from an investment perspective. So this principle set the foundation of Fenimore's investment philosophy, investing with the mindset that we're fractional owners of businesses, not merely holders of financial securities. And today, that's what I and our research team focuses on. We spend a lot of our time uncovering competitively advantaged businesses, assessing the defensibility and durability of those advantages, and then investing with a horizon that's measured in years and hopefully decades. Go to the next slide, Christian. with a little understanding of our philosophy, this is how we put it into practice. This is our research process. And on the left-hand side of this slide, there's 4 core criteria that every business we invest in must meet. It has to be 1, understandable business with enduring competitive advantages. 2, generates cash flow, has high returns on capital. 3, has acceptable amounts of leverage or debt employed, limiting our financial risk. And 4, it's run by a capable management team, typically with a proven track record of creating shareholder value. And of course, we want to invest in these businesses at what we believe is a fair price. On the right is the funnel that outlines the steps of this process. So this is a pretty extensive process. It includes things like document reviews, all the filings and earnings calls, management engagement, attending industry trade shows, discussions with expert networks, competitors, modeling, and producing in-depth written research reports that we call green sheets and are reviewed by our entire research team. This process takes months or even years before a company, if chosen, is added to our portfolio. And I think it's worth emphasizing because it really highlights just how thoughtful and judicious we are when we come to making investment decisions. I always say we don't need to swing the bat often when you have very concentrated portfolios. There's a really good example of how long, maybe on the long end, we can move fast, but on the long end, my colleague used to invest in this orthopedic company. And back in the late 90s, he would go to the orthopedic trade show every year and he would talk to the business. And one year he really noticed there was one booth where everybody seemed to be, gathering. And so he started to look at this business and engage with the company. And this was in 99. And we first invested in that orthopedic company in the fund, which we still own today, in 2010. So that's 11 years. Just shows you how long sometimes these things can take. And then, of course, once the companies are in the portfolio, it continues to go through this research process, kind of re-underwriting it on a continuous basis. If you go to the next slide, Christian, I can highlight some of the areas where I think Fenimore differentiates. The first is just the adherence to the investment philosophy. So regardless of what the market's doing, we really stay true to our approach. We've had this process. Our process has evolved over the years. We continuously get better. There's new tools, there's new ways. Information's easier to access, but the philosophy underpinning it has remained unchanged for over 50 years. And so when you're thinking about the repeatability of an investment return, if it's generated by a prediction, if you're making a prediction on where interest rates are going to go, and how that's going to affect securities, or what's the impact of the outcome of an election, you may be right and it could be very successful, but it becomes very hard to sustain. Making consecutive predictions are hard. We're more aligned to making observations and believe having a consistent process leads to the repeatable investment outcomes. We also have our in-house research. I highlighted the research process earlier. There's a really good data point to highlight this, though. We have a team of 9 on our research team. And last year in 2024, the calendar year, we conducted 276 management contacts. These are in-person meetings, calls, discussion with companies, could be at their headquarters, facilities, trade shows, conferences. It includes more than 100 in-person management meetings, and it works out to more than just 1 interaction per day. And put that in context, more than 1 interaction with a company per day management. And we have a portfolio across our strategies of just about 70 holdings. So this is a very high touch research process. The third on concentrated portfolios, as Tristan talked about, very active. We don't follow a model or index. Our portfolio is a carefully curated collection of 25 to 30 businesses. This reflects strong conviction in every investment we make. And because for 4, risk management, we don't compromise on the quality of the companies that go into our portfolios, despite having concentrated strategies. Our investment returns have had strong risk-adjusted attributes, which really means a good track record of outperforming in down markets. 5 is tax efficiency. This is just a natural outcome of long-term investing. It's an attribute of investing. It's not a goal, but we have an average holding period of 10 years for our investments, and that's less turnover, and less turnover results in fewer taxable events. We can do the math to show you that when you compound capital over time, you pay tax once at the end, that yields substantially more than paying taxes annually. And the sixth is service. And it's the foundation of the trust. Our service is the foundation of the trust we build with our clients. So as a member of the research team, I'm just as dedicated to client service as our relationship managers. I always love to challenge investors or clients, prospects to find other investment managers that offer direct access to investment professionals. So if you have a question, you're a $500 mutual fund holder or a $10 million account, and you have a question about a purchase or sale that was made, and you walk into our office, we have a lot of walk-ins still, or you get a call us up on the phone and you say, I want to ask, talk about this. We make ourselves available. So go to the next slide, Christian. And so I'm going to shift now to the cost of timing the market. So I gave you kind of the philosophy and the factors that really underpin how we think about investing. And I think one of the most valuable lessons we can teach investors is the importance of staying invested, particularly during turbulent markets. And I'm going to share some data over the next few slides that's going to support this belief and I think tell a really compelling story. So this slide that you're looking at right here, it shows the value of $10,000 if you invest in the S&P 500 ETF in January 2003 and invested for 20 years, didn't touch it. So $10,000. And the big blue bar on the left where it says invested all days is if you put the money in, didn't touch it, your $10,000 would have grown to almost $65,000, 6.5 times your return. Now we know that journey wasn't smooth. This wasn't a linear return where you just compounded to 6.5 times. There were significant events. You had the great financial crisis. You had the U.S. losing its AAA credit rating. We had a global pandemic that shut down the world economy for a year. And yet, during that 20 years, the best thing an investor could have done was just stay invested. And investors who exited the market to avoid losses, they often can pay a steep price. And that's what the rest of this graph shows. So the next bar right to the right that says missing the 10 best days. If you miss just the 10 best days over that 20 years, just 10 days, your return over that 20 years would have been cut in half. You would have gone from $65,000 to less than $30,000 of return. And if you go all the way to the right, which it says missing the 60 best days, and I'll admit, you have to have really bad luck to only miss the 60 best days of the market, but it helps illustrate the point, which 60 days, by the way, is only 1% of trading days. Your capital, your invested capital would be only $4,200, less than half of your original investment. And I think the message is clear. The best strategy, particularly in challenging times, is to stay invested. On the next slide, we highlight the best days in the market when they occurred and what their magnitude was. And again, this is trying to create the same point about staying invested and the cost that can happen when you try to pull in and out your money in the market. Now, the single best day over the last 20 years was October 13, 2008, and the market was up 11.6% that day. That's a full year's return in just one day. So for context, the Russell Midcap, the 10-year average annual return right now is 9.7%. So in one day, you got your full year's worth of return. And what's particularly fascinating, you can tell with the dates of all these returns, is when they occurred. And you can tell that they happen typically during major market downturns, especially bear markets like the 2008, 2009 great financial crisis, as well as the pandemic in 2020. And I think the dates will tell you, this chart reveals a pretty good truth, simple truth, that markets can rebound very quickly. And if you exit during the downturn, you risk as an investor missing critical recovery periods. And it's why we consistently encourage our clients to maintain a long-term focus and avoid reacting emotionally to short-term market fluctuations. If you move to the next slide, this is a chart using the Russell Midcap Index. Why the Russell Mid? And you hear the S&P. This is just typically, this is an index, by the way, that just shows what mid-cap companies, and mid-caps are typically defined as 10 billion to 65 billion. And only in the world of finance is 65 billion considered mid. But this just shows the returns. We invest primarily in the mid-cap space, which is why we use the mid-cap index a lot. But you can see the annual returns over the last 6 years. And my first reaction is this is actually pretty good. 2022 was a tough year. We had a down 17% year, but beyond that, in 2019, 20, 21, 23, 24, we had double-digit returns every year. It's a pretty robust equity market and a good time to be invested. The thing is, though, is if you look just at this chart and you look just at annual returns, you can think that market returns are a lot smoother than they actually are. But if you overlay the daily price movements, which we do on the next slide, it tells a very different story. So let's look at the pandemic, for example, in 2022. The market was up 17% this year. Oh, if I put my money in January and I took it out in December, I was up 17%. However, you would have had to live through a 34% drawdown in just 1 month in 2020. And more recently, in 2023, a year where the market also returned 17%, we saw a 15% drawdown in 3 months from August to October, followed by a 20% rebound just the subsequent 2 months in November and December. So markets can swing wildly in the short term. So it makes staying invested critical. Investors who try to avoid the pains of drawdowns, whether 2020, 2023, or even 2022, can miss out on the upward movements. It's the best long-term strategy, we believe, is to stay invested and allow wealth to compound tax efficiently over time. And I'm going to end with one last chart. This one addresses a little bit of a different question about market timing, but it's a really good chart that I love sharing. And the question it addresses is, which is the question I get the most often. What's the most often question I get from investors? Is now a good time to invest? And this slide, what you're looking at is what we call a bull bear chart. I keep this is my own chart. I keep this internally. I love to share it, but I've borrowed it from a legendary investor. His name is Sir John Templeton. And he's known for being the first investor to really invest globally. He's the first one that started investing in like Japanese markets back early on. And his status in the investment world is on par with people like Warren Buffett. Now, this chart starts in March of 1957. It starts then because that's when the S&P 500 index, as we know, was introduced, and illustrates bull markets in green, bear markets in red. And just for context, a bull market is defined as a 20% rise above the previous bottom, and a bear market is when the market drops 20% below its previous all-time high. And what's clear, there's a visual takeaway that is obvious to anybody who doesn't even know anything about markets, is that there's far more green than red, which tells you that bull markets are longer in duration and greater in appreciation than bear markets. And that staying invested, we always tell you, you can make more money on the upside than you lose on the downside. And I like to use this particularly when there's concerns in the market, geopolitical concerns about any specific macro event, and highlighting what the impact may be. And I always love to remind people that the concerns we have today are not new concerns we're dealing with. I'll give a couple examples. So Middle East conflict. We're dealing with Middle East conflict. We did get great news of a ceasefire, but in 1973, we had the Arab-Israeli war. You had the OPEC oil crisis, and we had a 48% correction over 21 months from 73 to 74. There's concerns. There were, significant concerns over the last few years about the impacts of rising inflation and interest rates. We've dealt with that before. In the early 80s, mortgage rates actually exceeded 18%, and we saw a 27% correction over 20 months in the early 80s in the S&P. And of course, there's always the evergreen concern about recession. And are we going to go into a recession? The great financial crisis remains the worst recession and bear market in history. It dropped 57% in just 17 months. But the crucial point through all this is that in each one of those instances, whether it's the Middle East conflict, the inflation and high rate environment, the great financial crisis, each of these markets was followed by a bull market that exceeded the sell-off in both returns and duration. So we always love to remind people volatility isn't something to fear. Rather, it's a feature that must be endured for investors to enjoy the benefits of long-term compounding of equity returns. So I will stop there. I'll turn it back over to Christian.
Great. Thank you, Will. Looking at the clock, we actually stayed on time. All right. Good job, us.
Oh,
So
there's a lot
Pat,
of work to do.
yeah, Pat, I'm happy to hand it back to you. If you want to ask questions, I can read them out, whatever works for you.
Yeah, no, I think it's really appropriate to ask Will this very first question that we have on our list because it ties into what he just talked about, which is historically, how long has it taken for the stock market to rebound from a serious decline like the Great Recession of 2008, 2009?
Yeah, so that's a great question, Pat. The Great Recession, how long does it take to rebound really starts with what caused and how severe the decline was. So for the Great Recession, as I point out, it's the worst bear market. It was by far the longest recession, and it took about 4 years to fully recover losses from the bottom of that market. But that's part of that is indicative not of like the average bear market takes 4 years post bear market to recover. It's really indicative of just how severe the downturn was and just how widespread the scars were and the destruction from the financial crisis was into the financial industry. If you look at other downturns, so I'll give you 2020 as an example, the pandemic, it only took about 5 months to recoup losses there. And then in 2022, the bear market we had because of rising rates, the Fed raising rates, that was about 15 months. And it's important. So if you look at averages, you're closer to about a year on a typical downturn and recovery. Importantly, we've never had a bear market that hasn't fully recouped its losses before turning down again. So we've always come out of bear markets. We've always enjoyed new highs before we've had something new to worry about.
Well, and you know that as you've just stated, the most important thing is just stay in the market, and that's difficult. This question that someone posed is, with the challenges of keeping up with the economic trends, how does one avoid that emotional decision making during these fluctuations? So we all know, we read in the press, as you pointed out, the market's dropping, the market's dropping. Should I jump out? Should I jump back in? What should I do? How do I keep myself from reacting to these day-to-day fluctuations in the market?
So I'll take that one, Pat. There's a famous investor that's often quoted on this topic, and he said, "You just have to overcome human emotion." So easier said than done, right? I think a more practical answer is have a plan. And our plan isn't the right plan for everyone. There are a lot of factors that go into the best individualized plan for you. But it generally is a really good idea to have a plan with respect to your wealth, maintaining your wealth or growing it, depending on what your goals are.
Well, and so to that point, if you really just got some substantial amount of liquid wealth, like you sold your business or something else, how do you time putting that money back in the market or in the market in the first place?
That's a great question. I can see Will licking his chops on this one. Go ahead, you can answer.
Yeah. Well, it really depends on what the plans are with the capital. And again, if you have an investment horizon, what you plan to do with it, that measures in decades or years and decades, and you have a long-term horizon, you don't need it for things in the short term. The best time is always now. And we say that because when you look at the returns that the equity markets offer, the most important thing isn't whether you bought even at the peak or bottom, the high, low in any given year. The most important thing is that you bought, that you got invested, because you got to enjoy the effects of compounding, which really magnify in those later years. If you said, hey, like I'm going to need this money, in 12 months. The best time to invest is probably never. You're going to need that money. You should not put that in the equity market. So it goes back to Christian's comments about having a plan, understanding what you need to do with it. But if you have a long-term investment horizon, you really don't need to go beyond a couple years before the best time to get in is to invest. And we track this internally. We have as Chris pointed out, a big SMA business, a lot of different client accounts. We've tried to change up different ways in terms of how we get clients invested, being, over time, dollar cost averaging in the best performing accounts that have always been the accounts that when we got the money, we put it in the market. Markets go up over time. I think it's about 75% of the time in any given year. So if you just, by investing, you're just putting the odds in your favor.
So I'm going to remind everyone to please put your questions in the Q&A or the chat. And while they're doing that, I'm going to take the opposite side of that question, Will, which is, what about taking your money out? What if you have a huge major purchase that you know you're going to make in a specific year? Do you take a little bit at a time? How do you time taking money out of the market so that you have it available for something you want to buy or purchase?
You want me to take that one, Will?
Yeah, go ahead, Christian.
I'm gonna give an annoying attorney answer, which is it depends. But that's also a realistic answer, and it comes back to having a plan, Pat. It's a great question. If you know when you have cash needs in the future, whether they're in 6 months, 12 months, 2 years, 5 years, you're going to buy a second home, you want to retire, so your income needs changed. All of those factors play into creating usually a plan based on an individual's goals. And those goals inform the question you asked, both how you're originally invested and how those investments are managed to meet your future cash needs. So again, it really comes back to having a plan.
But you talked about that you invest on an after-tax basis, which I think is critically important because a lot of firms don't focus on the tax consequences. You heard the old expression, what is that? The tail shouldn't wag the dog or whatever, right?
Mm-hmm.
I mean, I've heard that my whole life, I think. So you need to worry about taxes, especially when you're liquidating assets. So do you think about that? Do you look at the positions and say, this is a better tax answer? Obviously, you have to pick the best investment answer, but do you look at the tax consequences of any liquidations that you make?
Yeah, I don't have to give a lawyerly answer on that one. Absolutely. So one of the benefits of a separately managed account is that we can align exiting positions with tax considerations for that individual client or organization. And that's something that Will mention on the SMA side of this, the private client business. We have a traditional model. We have relationship managers, and those relationship managers focus a lot on that with a lot of our clients.
Yeah, it does dictate from an SMA standpoint just how we think about the investment decisions. Certainly, if the opportunity is great, the tax consequences are always second to that. But part of the equation in terms of like selling something and investing in something new is we're not selling maybe $1 million worth of investment if there's a huge capital gain involved, right? We're actually only selling 800,000 or 750,000. So it changes the equation a little bit, the bigger the tax liability that's in the position, and it can ultimately dictate, what your expected returns are, kind of in a position if there's a huge embedded gain versus something that really hasn't worked and has no gains in it.
So let's talk about something that was on the list of questions, but also is on everyone's mind, and that is interest rates. And we've gone through this period of inflation. We've lived through higher interest rates. They seem to be coming down, but how do you manage interest rates and its impact on the investing that you make?
Yes, I could take that one. So Warren Buffett has a great quote, which I did write down, which really underscores this. It's interest rates are to asset prices like gravity is to the apple. They power everything in the economic universe. And really what that gets back to is the most important thing when you're trying to value any asset, whether it's a stock or any other financial security, is what are interest rates? What are long-term rates? If you told me I can know one thing in the next 30 years to help, or even the next 5 or 10 years to help make an investment decision and how I think market returns are going to be, it's tell me what the long-term interest rates will be in 5 years. Because that's going to really lead the market direction. And it's something we saw over the last 3 or 4 years here as inflation reared up and the Fed had to take action through interest rate policy to help trying to rein in inflation. So it's the most important thing. We do pay a lot of attention to it. It changes the valuation of securities, and it will be the most important thing. There's a lot of geopolitical risk. There's a lot of economic risk that people can be worried about. I think the most important thing to anybody's return sitting here, and regardless of what asset class you're invested in over the next 5, 10, 15, 20 years, is going to be, what direction interest rates go.
Well, so let's talk about this political risk. We all know we're in a whole new political environment. The Republicans now have the trifecta, the House, the Senate, and the White House. We're going to have that new administration on January 20th. We all have speculation about that, but you both know that TCJA is going to expire, and a lot of those tax provisions that helped a lot of the viewers on this call and family businesses throughout the country are going to expire, and they're significant. So at Family Enterprise USA, we're worried about the income tax rates going back up because we've learned that 80% of our family businesses operate as a pass-through entity. So they're paying ordinary income tax rates. That was also why they're worried about 199A. We'd love to make that permanent. They're worried about capital gains tax rates. They're worried about R&D expensing. Certainly grave concern around the exemption amount, the lifetime exemption amount for the estate tax going down, reverting back to maybe a $7 million level from its current $14 million level, or even the rate of tax going up, as well as other provisions. So there's a lot on the table. And it impacts it'll impact our economy, certainly our government revenue, and certainly investments. So what is your take on how is the new Congress, the new administration going to impact the investing world?
Yeah. Oh, that's a really good question. The R&D 174, that really frustrated me too. Frustrated a lot of our companies really suffered from that on the tech space, and it really kills the startup cultures there too. So that one, I was always hopeful that would have got fixed a lot sooner than it did. Our macro predictions, so I'll answer the question, but I always preface this: they're more likely to entertain than be accurate. Okay, so as you know, we talked about what we do, but from a tax standpoint, so from the Trump administration, we're in the unique situation where we actually have an administration that we've had before. All right, that wasn't just like a extension, another reelection. So this has only happened one other time, but the benefit of that is it's known. I mean, we really know, even if it's considered maybe a little capricious, policy, behavior, it's a known quantity. We know how they react, how they act, how they run the administration, what their primary focuses will be. And one of the things that gives me comfort that things will get done is one of the biggest external scorecards for this administration in the past 4 years, in 2016 and 2020, was the stock market. And how was the stock market doing? And so I think, obviously, this is something that benefited a lot of businesses on corporate tax reform. Anytime you drop tax rates from 35 to 21%, the amount that equity owners get to keep goes up, raises asset prices. Letting that roll off will be a net negative for stock valuations. And I think the administration will be aware of this and the impact. They certainly wouldn't want to have policies that go through that hurt these businesses, but more particularly hurt the scorecard in which they benchmark themselves, that they hold to, right or wrong. So I'm confident something will get done because they won't want to deal, regardless if it's needed or not, won't want to deal with potentially the negative impacts of that. Beyond taxes, there's a lot of policies that that are being talked about. In fact, I think we just announced they're going to have the external revenue service. Like, tariffs are real. Tariffs were real in 2018. It was a trade war. What we do with policies, administrative policy. We talk to our businesses, and we really try to understand how they're going to impact, how are they managing it, and really try to get comfortable with it on a company by company basis. It varies by company, varies by industry. The important thing to remember with like a tariff policy, and why I actually don't think they'll be as negative or as impactful, is because we did this already in 2018. The businesses had to deal with a lot of tariffs, And we also went through the global pandemic. They had to restructure their supply chains. So, you're set up better to handle these tariffs. And as we're always reminded when we talk to them, the tariffs in 2018, they never went away. This last administration never took them off the table. They've been dealing with them for the last 6 years, and expect to continue to deal with them. So, I think from a administrative standpoint, it's hard to predict those things. He positions themselves as very pro-business. Their external scorecards should support favorable policies, but we really don't know.
Yeah, and I would add to that while that's the case, we know what this administration has done in the past. We have an interesting Congress, right? And even though the Republicans control the House, it's a very slim margin. And so it's likely that they're going to need Democrats to get things through it. And I tell people that the president can do a significant amount on his own, but the reality is Congress typically is passing our laws, and they've got to get through the House and they've got to get to the Senate. And it's going to cost $4.6 trillion if this whole tax package became permanent. So all of these provisions stayed in and became permanent, which we think is probably unlikely because we don't have $4.6 trillion in this debt situation that we are as a country. And so I would agree with everything you said. I just really want people to understand it's not going to be easy. You really have to stand up and talk to your members of Congress, tell them how it affects your businesses and you personally. It's critically important, probably more important this year, I tell people, than in 20 years since we've been making these kind of policies. So I really encourage everybody to do that. It's so very important. So with that, I'm going to switch gears a little bit. And this may be our last question unless we get other questions or either of you have their comments you want to make. And I'd be happy to answer this question too, having spent over 30 years in the family office industry myself. But the question is, what is the time to start talking about using a family office? And I would add to that, or forming your own family office, because we all know there's a big distinction between a single family office and a multi-family office. So I'll let you all answer that and then I'll add my thoughts.
I'll start, Pat. This could be a fun conversation. So this is very personal to me and us, because I have been talking about the founder of this firm and his family about this very question and sort of the structure of the family office within Fenimore. So I think the starting point is, what do you mean by family office? Family office services and a family office is like the ultimate bespoke offering, meaning it is entirely unique to every family that either establishes their own single family office or uses an external multifamily office. Highly tailored service. So I think about it in kind of three categories. So investment management, the stuff that Will and I have been talking about, managing money, wealth management, sometimes referred to as planning. So things like trust and estate, tax, philanthropy, those items, and incorporating those into the investment management. And then lifestyle services, so art collections, wine collections, travel, support of some of the trappings that come with wealth. So considerations, I think I'll throw out a handful, and then certainly, Pat, I'll hand things over to you as well. Like, I think time is probably one of the biggest ones. And in my travels, I have encountered families that, they have a very complex life and web of service provider relationships. They know the gardener, their lawyer goes to church with them, their tax accountant, is their kid's softball coach. But the idea is the components of their family office are their community, and they don't want to disrupt their community. And that kind of leads to one outcome in terms of family office services and the decisioning around it. At the other end of the spectrum, some people don't want to deal with the administration of their life. And the wealthier you get, the more administration there tends to be. And they're willing to pay a premium to have a single point of contact or a team that does any of the items I mentioned to all of them, wealth management, investment management, sort of general lifestyle services. And whether they establish their own or use a multifamily office, a professional service provider, it can be a great solution. Just one other quick parameter, Pat, and then I really will hand it over to you, is there's definitely an economic benefit. I mean, I've seen when you effectively integrate the myriad specialists that families of significant wealth tend to have, tax specialists, multiple lawyers, planning, investors, when they're integrated, and again, going back to a plan, there is a comprehensive integrated approach. There tend to be economic benefits, either in the form of tax savings, heightened investment returns, or other very clear financial benefits. So, Pat, I'll hand it over to you.
Yeah. So I would agree with everything you said. I think it's so very important to figure out what you want to do with your life, what services you want to have provided to you, how you want those services delivered, how large is the family, how many generations of the family, how many households, what are the services that each of them needs. And as you said, how do you want to spend your time? Because managing a family office is a business. And you have to recruit talent. You have to have career paths for that talent. You have to spend the time that's necessary to run that business every day. And I think when the single family office was formed, not the days of the Rockefellers hundreds of years ago, but in the 90s generally, it was the consensus that if you had $100 million, you could justify your own single family office. I think that world has changed dramatically. First of all, the world's become so much more complex and complicated, sophisticated, that you really need, in my opinion, again, it depends on all those factors we talked about $500 million to $1 billion to even think about having your own single family office. There's certainly exceptions to that. There's no question about it. Depends on what the assets are. And that's why I think this multifamily office model has grown so much, because families see, as you pointed out, I don't want to spend my time doing this administration of my wealth. I've worked hard to earn it. Now I want to give it to the experts and let them do it. And to your point about economics, sometimes the multifamily office is a better economic answer because they have multiple families and they can spread the costs over all of those families as opposed to one. So I just really encourage people to think about what their needs are, and as you say, put a plan in place. Make sure you know what you want first, and then do your research and interview people that have single family offices and multifamily offices, and figure out what's best for your family, because nothing fits everybody. So I think you have to do your homework. So I think obviously we've told everybody everything they needed to know, because there's no questions. So I would ask either of you have any closing remarks that you would like to make?
Just thank you again. We really appreciate the opportunity to work with you, Pat, and your team. Thank you for everyone that took the time to join us today. Hopefully you learned something or you have a takeaway. I would add, I am happy to chat with anyone directly, as I'm sure Will would be, on anything we talked about today, whether it's family office, investments, or anything in between. So thanks, Pat.
Well, thank you both for being on here today, and thank you, Christian and Will and Fenimore Asset Management, for being a sponsor and sponsoring Family Enterprise USA. We really appreciate that sponsorship. And Christian, you've attended a lot of our events, and we really appreciate you doing that as well. So thank you both. Have a great rest of your day. And thanks to everyone who joined us on this call today. Take care.